I'm Roger Baker, Executive Director of the Stratfor Center for Applied Geopolitics at RANE, a global center of excellence for geopolitical intelligence and analysis. Learn how you can put geopolitics to work for your organization at ranenetwork.com.
Hello and welcome to this special episode of RANE's Essential Geopolitics podcast. Today, RANE's Middle East and North Africa analyst, Ryan Bohl, and RANE's global economy analyst, Markus Jaeger, will be discussing the outlook for the global economy given the Trump administration's aggressive approach to tariffs in recent months. Hey, Markus and Ryan, welcome to the podcast.
Okay, well, Markus, we're outside of my area of domain. I have to watch the economy of my region, but certainly not the situation globally. And so I think for my own sake, if we could narrow it down and start with the place where the change to the global economic environment is happening the fastest and the most significantly, that would help me a lot. And so I'm thinking maybe we could start off with looking at what is going on in the United States economically, and what is its outlook going forward?
So I think where things are happening is in the United States, and a lot of that is owed to U.S. trade policy since the new president came to power. So just this morning we had a release of first quarter GDP, and effectively the economy shrank 0.3% on an annualized basis. Just to put this into context, the fourth quarter of last year we had 2.4% growth. And just a few weeks ago, analysts were still expecting 0.8% growth for the first quarter. So this is a fairly, I guess at this stage expected, but 2 months ago, unexpected turn of events, because the economy was coming along nicely. It was growing. Disinflation was underway. The Fed had already started cutting interest rates. So things were coming along very nicely. And of course, what's changed is the fairly forceful and very protectionist U.S. trade policy that created a lot of uncertainty, not just in the U.S., but also globally. But I'd be remiss in not analyzing those figures a little more in detail, because what's basically happened is that the tariffs and the tariff announcements or concerns about future tariff hikes have really led to a massive surge in imports into the U.S. And I'm not going to bore you with the details, but the way you calculate GDP, one component of it is net exports. So if you have a surge in imports, it basically subtracts from your final GDP number. And this is also one of the reasons, by the way, why equity markets were weaker this morning. But overall, there was not that much change in fixed income markets. I think markets and economic analysts realized there's a lot of noise in the data. And so we had this surge in imports, and it's quite possible that imports then drop off in the second quarter and you get a better number. If you look in the numbers in more detail, personal consumption held up relatively well. Government spending was down, which is perhaps not all that surprising. So I wouldn't read too much into those numbers, except to say that they are a reflection of this massive increase of uncertainty that we've seen since January 20th, I suppose. And this uncertainty really is beginning to weigh on the economic outlook. Again, today's numbers, let's not overinterpret them, but also bear in mind, of course, that many of the tariff increases have been suspended until July. But this uncertainty itself has already begun to have a negative impact on the U.S. economic outlook and also on the economic outlook on the rest of the world. But I'm sure we'll get to that question in a little bit.
Well, so when we're talking about definitions here, to a lot of lay people, negative GDP, as they understand it, a shrinking economy, they think of that as a recession. Is the United States in a recession, or is it on the path to one?
It's not in a recession. So recession is a very technical term, and you're right to point this out. A lot of laymen will say something bad happened in the economy. We have negative growth, or the economy shrank. That's a recession. Technically speaking, a recession is 2 quarters of negative economic growth, and then you still need to have a committee opine on what happened and declare a recession. So it's kind of a committee involved here. So we are not in a recession. Having said that, the IMF recently came out and increased the probability of a recession in the US from 25 to 40%. Again, this is very much owed to the tariff situation. My personal view is, yes, I think economically things are going to get worse, But whether we're actually going to get another quarter of negative growth, I'm not entirely sure. But it's very clear this uncertainty is weighing on the economy. And this is, you just don't look at GDP data. You also look at high frequency indicators like consumer sentiment, investor confidence, and these sorts of things. And no matter where you look, things have really, really deteriorated in the US and not just in the US. So there is a sense that the economy is on the wrong path. And this is even before the tariffs have kicked in. But I'm not entirely sold on the idea that we necessarily get a second quarter of negative growth. But structurally speaking, the outlook for the rest of the year is worse. And by the way, just as a last thought on this, the IMF has also downgraded its growth outlook for the US, I believe, by, I think, 0.2 percentage points or something along those lines. So it's not dramatic, but also bear in mind that these tariffs, they will have a short-term and a long-term effect. So the whole point is, structurally speaking, we are trending in the wrong direction here. Again, coming from a situation where things came along quite nicely, including like 2024 and particularly the end of 2024.
Well, Markus, if I can ask you about some recent history, in 2022, I believe it was Bloomberg, was saying there was a 100% chance of a recession within a year, and we never did get one. What's different now with the way the forecasts are coming out about recession risks, and what's different now between now and the last time we had a downturn in the markets and fears of economic slowdown?
So economic slowdowns, they come really in a variety of ways. Like if you go back to, for example, 2008, 2009, what triggered the downturn there was the massive financial crisis in the United States related to the real estate market and CDOs and so on and so forth. Typically, recessions in the US happen when the Fed tightens economic policy in a situation where domestic demand is overheating. That's your typical recession. Then you had COVID, where you had a massive supply shock. People couldn't shop anymore. There was a decline in confidence. So again, here, the cause of that particular recession was different again. And this time around, I would also argue the cause again is not your typical recession, clearly not. I mean, the Fed, you could argue, may or may not have over-tightened, but it didn't look that way at the end of last year. Clearly, what happened to the sharp decline in GDP growth in the first quarter is owed to the fact that economic agents are not sure what to expect. And if they expect anything, they expect things to get worse because tariffs mean that consumers will be losing money. It means supply chains will get disrupted. And companies will say, well, are we going to invest? Where are we going to invest? Or are we going to cut staff? And that's what we're seeing right now. I just saw yesterday UPS, I think, announcing a layoff of 20,000 people because they expect Amazon deliveries to decline. And I assume they expect it to decline because just the prices of Amazon goods will go up, hence there will be a decline in demand. So to answer your question, this time around, it's really the uncertainty created by and around US trade policy. Now, the administration will argue that's all for the good in the long term. That's a separate question, but I think it's unarguable that it was the uncertainty around trade policy, and not just trade policy, also we've seen comments come out of the administration attacking the Fed. This stuff really doesn't help. It doesn't really help reassure economic agents, whether they're consumers or investors. So this time around, I think it's very clearly the dramatic shift in US trade policy that underpins the weakening of the economic outlook.
Well, and so shifting then over to the tariffs themselves, can you give us a little bit of an overview, both of their impact on the United States and then on the United States' trade partners, and then maybe you don't have to go too much out on a limb here, but where do you think America's tariff strategy could go? Maybe there's more than one path when you think about that.
So I'll tackle the first question first, because the second one I feel like there's a lot of speculation involved, but I certainly have a few thoughts on this as well. So tariffs. So what tariffs do, all other things equal, but basically that's really supported by the empirical evidence. Tariffs are a tax on the consumer, and in most models, under most circumstances, it means that import prices will increase. So that per se would be inflationary. It should also, all other things be equal in the short run, be negative for economic growth, because consumers will have to spend more on certain items, so they have less money to spend. So again, this all other things equal. If other things happen in the economy, like an expansionary fiscal policy, low interest rates, this may just be offset. typically also, and we haven't seen it this time around, but higher tariffs should in theory lead to like a stronger exchange rate, so offset some of those. But broadly speaking, it is negative for economic growth in the country imposing those tariffs. It's also negative for economic growth for countries that face those higher tariffs. Why? Because if they depend on exports to, say, the United States, not being able to access the US market or accessing it at higher prices because of those import tariffs means that there will be less demand for those products. So they will be hit on the net export side of things. So this is why export-oriented economies, in particular those who sell a lot to the United States, they will be most impacted by those tariffs as a sort of primary effect. Now, in this case, and this is all a question of like orders of magnitude and degrees, but in this case, the US tariffs might even be deflationary. Why? Because they reduce demand for this country's export products. And so to that extent, they might offer price discounts, and they might be at the margin deflationary. Once again, there's a lot of things you can do to offset those sorts of things, but the long and short of it is, under almost all circumstances, and there's some very few exceptions, but under almost all circumstances, higher tariffs mean there's a welfare loss both for the country that imports those goods. Think of consumers who have to pay more for their Apple products. And there's a welfare loss for the countries exporting those things because they export less and they suffer from lower economic growth. Now, I just want to quickly say a word about the exceptions. There is in economic theory a thing called optimal tariff theory. The idea is that under a certain specific set of circumstances, a very, very large country is able to impose tariffs and force the exporting country that is highly dependent on the larger importing country, force this country to lower prices. So in other words, in this case, the higher tariffs will be absorbed into the profit margins of exporters. But there's very few economists out there who believe this is going to happen, and if it happens, it would happen at a very, very small scale. So the assumption is, and I think that we will see that those tariffs will mean higher prices for U.S. consumers. But I just want to put it out there that I do think that some people in the Trump administration, whether they're aware of that theory or not, they're working on that assumption, and they've been saying as much without necessarily using the word optimal tariff theory, that by the U.S. raising imports, it will force other countries to sell their products at a lower price, and hence the impact on U.S. consumers would be less. Now, to your second question, where will this go? I'm not sure. I think you can look at this and say there have been a lot of announcements, and there really have been a lot of announcements on trade policy. There have been a lot of aggressive announcements, but also a lot of retreats, if you will, on trade. I mean, the most dramatic one, of course, was after the announcement of the reciprocal tariffs in I think April 2nd, early April. And then the bond market went haywire, the dollar sold off, and it seems like this led the administration to reconsider and suspend those tariffs, at least the reciprocal tariffs, not the baseline tariffs of 10% on all U.S. imports, and except for China. So if you take that reading, you think that you would probably have to assume that, or expect that as things worsen in the U.S. economically, the pressure will increase to be less aggressive on tariffs and negotiate bilateral deals, sit down with the Chinese and bring down these very, very high tariffs rate, which are now at 145%, which basically means there's not going to be much, if any, trade between the US and China. At some point, it's like, okay, let's sit down and negotiate and maybe extract concessions, but let's help to bring down those tariff rates. There's another school of thought, and I think it depends on who you ask in the White House and in the administration. They think this is just the cost that you incur for restructuring the U.S. economy. I think the president has said as much, saying, yes, we impose those tariffs, and this will lead to more investment coming into the U.S., more employment in manufacturing. Most economists doubt this, and I think there's good reason to doubt this will have a very significant effect. But my point is there are people inside the administration, potentially including the president, that believes that these tariffs will have a beneficial effect down the line, and therefore they will perhaps maintain, if not all, many of those tariffs, and will actually impose some of those reciprocal tariffs, which would come into effect now 3 months after April 2nd. So I guess we're looking at July 2nd, July 3rd. So these are the two schools of thought, and I guess we really have to say how things play out. My guess is the worse the economy gets, the pressure will increase in the administration to go easy on some of those tariffs, and then there will always be some face-saving trade deals to be had, particularly with allies and potentially even with China. What I don't think we'll get is, I don't think we'll get back to the status quo ante. I don't think we will get to the end of the Trump administration and tariffs will be where we started at the beginning. For a start, we'll have sectoral tariffs, supposedly introduced on the basis of national security, and there will be a bunch of other tariffs on various other countries. So we will not go back to where we were, but my guess is we will not have tariffs as high as they are meant to be once the reciprocal tariffs kick in, and there's lots of other things in the pipeline still where the Trump administration is willing to impose further tariffs. So not going back to status quo ante, but the tariffs will not be as high as they currently are meant to be.
Yeah, I think, Marcus, that's a good overview of what the Trump administration is trying to do. And as long as they believe that this is the way you restructure an economy, it becomes hard to see that world in which tariffs are ever rolled back. This is the new economic model that they want to try out. And he is, after all, the second-term president. He doesn't have another election he ever has to win again. So they can take these kinds of risks. We just haven't seen it in a long time from a president, which is why I think, in one part, it seems unfathomable to many people that a president is willing to go out on a limb on an untested and in some ways unvetted strategy to try to achieve something this big. Now, with that all said, I'm curious. Let's go global and let's think about what the impacts of these tariffs and this restructuring strategy will have both on America's trade partners and, of course, in some of its rivals and adversaries like China. So I'll kick it over to you where you would prefer to start. We have our near abroad in Mexico and Canada, and we did just see in Canada some political effects of this trade war has resulted in an upset of an election. Or we could start in the European Union or in Asia, but wherever you prefer to start, Marcus.
Okay, well, let's start with China because China is the country that's been most affected by those tariffs. So China is it's not actually a massively open economy, but it does do a fair amount of trade with the United States, and it has really been hit the worst. Right now, the average tariff is around 145%. This compares, I think, to an average tariff of like 20% before Trump came back into office a second time. But of course, that rate is already much, much higher than it was at the beginning of the first Trump administration. So the point is, China is the one that really has been and will be affected the most if tariffs stay where they are. Now, there is a sense that China has been relying on exports. It's not just a sense. There's a reality. China has been relying on exports for much of its, not for much, but for a lot of its economic growth over the past 40 years, quite frankly. And arguably, it's doubled down in the past few years, not so much by per se pushing exports, but by simply investing a lot. And investment creates a lot of capacity, a lot of output. And to the extent that this output does not get consumed in China, it needs to be exported. That's sort of macroeconomics 101. So the idea here is that these tariffs will be a significant shock to the Chinese economy. And I think we got manufacturing data this morning coming out of China. They already saw a weakening of manufacturing activity. And that's fair. On the other hand, as I said, it always feels like China is massively dependent on exports, and much depends on how you define dependence. But the contribution of exports, net exports, this term I mentioned earlier on, to economic growth over the past few years was only around 20 or 30% of the overall growth numbers. So let's make a simple calculation. Let's say GDP growth was 5% or higher, then 30% of 5% is like 150, 200 basis points, something like that. So it doesn't mean that China would go into a recession. The second thing is, yes, in a sense, it comes in a very inopportune moment for China because, as you know, they've been trying to rebalance the economy away from real estate to other areas. But I think that precisely led to increased investment in other areas, which then led them to export more in the past few years. So in that sense, China is now in a position where it really should expand domestic demand. It's not the fact that China has no money. It's a question of what does it do with the stuff it produces. And to make itself less vulnerable and sensitive to, say, U.S. tariffs and, quite frankly, to a broader global economic slowdown is you stimulate the economy domestically. And the way you should do this is by increasing domestic consumption. Now, that requires a lot of fiscal macro policy measures, which I'm not going to get into. But in a sense, yes, the short term, the frictional costs will be high, because who's going to buy all those iPhones that were supposed to go to the US, even though they've been exempted? Can they be absorbed domestically? But over a period of time, you can certainly re-engineer the economy and simply produce the stuff that you send abroad in the guise of trade surpluses and also in the guise of like US trade deficits, and simply consume it at home. So, and I think in a sense, the Chinese authorities, they've seen this coming and they have not budged at the negotiating table. But what they haven't done either is really try to support domestic demand. So my guess is we'll have to wait and see. And I think the authorities are trying to wait and see how much of an impact these tariffs will really have on on economic growth. And then they will take measures. And I think they're in an okay position to counteract at least some of those tariffs. And remember, China's growth rate is about 5%, 4.5%. Let's say they go from 4.5% to 3% because of those tariffs. It's not going to be the end of the world. It's not great. I'm not saying China is not vulnerable in many ways, but it's not going to be the end of the world. And so I think that will also be an important driver when it comes to if and when there are negotiations between the US and China. That's been an interesting, important driver as to how these negotiations will pan out. But clearly China is a country that will be affected, but quite frankly, all countries around the world are affected by US tariffs, depending on the extent to which they export to the United States. And then one more thought on this, and we can talk about this later, the secondary effects of those things, right? So one is you lose direct access, but because of those tariffs, and perhaps because those US tariffs lead to a slowdown in the US and a global economic slowdown, you have secondary effects on commodity prices, on global growth. So you kind of get hit twice, via tariffs and via a sort of synchronized global economic slowdown. And China will not be able to escape this. But I also don't think that China will simply we won't see growth rates collapse if only because the Chinese have enough leeway to counteract some of this tariff-induced slowdown.
And yeah, I think the secondary impacts are going to be something we're going to want to talk about towards the end of our conversation. But let's shift over then to Europe and the EU, which has not yet gotten the full brunt of the China treatment, although Trump keeps threatening that they might or that they will. And so what's the status of the relationship between the U.S. and the EU right now, and what are the effects for the Europeans and for countries that aren't part of the European Union anymore, like Britain?
So I would discuss those separately, because the EU is a very substantial economic bloc that is much better positioned to take on the United States when it comes to trade tensions and tariff wars. Smaller countries, they only stand to lose from this. They simply do not have the ability to, if you will, inflict much harm on the US economy. Having said that, the Europeans have been relatively well behaved in the sense that they want to negotiate and they have refrained largely from retaliation. But they have been hit by Trump tariffs. So they have been hit by some of the sectoral tariffs on steel and aluminum, on autos. But they also have been hit by the 10% baseline tariff. Now, the reciprocal tariff has been suspended, and the Europeans are hoping to negotiate. So they're hoping that they would sit down with the administration, see what the administration wants, and then hopefully find some sort of way out of this. The way, by the way, this went down during the first Trump administration, when the Europeans decided to also, I'm not sure they retaliated. I think they suspended the retaliation at the end of the day, but they said, look, let's sit down and talk and let's see whether we can liberalize transatlantic trade. And that was an offer the first Trump administration took up, but it never really went anywhere at the end of the day, because these are complicated negotiations. Now, having said that, inside the European Union, I think there is, so first of all, you have some countries that are more exposed to trade directly, like think of a country like Germany, for example, versus, a country like Greece, in the sense that the German exporters are more dependent on the US than Greek exporters. But when it comes to retaliation, interestingly, it wasn't so much, it seems like Germany that opposed retaliation, but it came from France, Italy, and other countries. Now, this might be owed to tactical considerations to say why retaliate and risk counter retaliation, whereas while there's still time to sit down and hopefully talk and find some sort of agreement. maybe there was also the idea that if we retaliate right now and the economy does badly in the US, then we get blamed for this. I think this was a consideration on the part of the Commission to hold off on some of the retaliatory measures. And it's probably true if you retaliate right away, you simply run the risk of counter-retaliation. So why make the situation worse? Why not wait and see if you can sit down and negotiate? Having said that, sooner or later, I think Europeans will have to retaliate, if only to maintain credibility. And much will depend on how serious the Trump administration is about negotiations and what it is they actually want. Because one thing that I think we've broadly seen, based on like press reports, it's not always quite clear what the US wants in those negotiations. It's not quite clear who's really in charge. I know it's the Treasury Secretary right now in theory, but it's not always quite clear what the ask is. On the one hand, we have those justifications for tariffs, like migration, like unfair trade practices. On the other hand, we don't get much information about what the specific asks are and what countries would need to do to avoid those tariffs. One last thought on the economic outlook. The European economy has been ailing for a number of years now. That's coming out of the post-COVID slump. You had the Russia-Ukrainian war. You had high energy prices. And so the economy really has not been doing very well. Now, recently there was a much more optimistic sentiment because Germany modified its debt brake, so it can now spend a fair amount of money on defense and infrastructure. But now that sort of has been undermined by the threat of a broader tariff war. So the Europeans will also suffer from lower economic growth, but I suppose they hold out hope that they can sit down and at least negotiate away some of those tariffs. And that brings us back to what I said earlier. It really depends on what the Trump administration decides to do, whether some of those tariffs, to what extent some of those tariffs will be permanent and on whom. Are they going to be sectoral? Are they going to be across the board? Or whether they will take back largely, but perhaps not entirely, some of those tariffs vis-a-vis its allies. So a lot of the outcome of this will hinge on what can be negotiated. But surely in the short run, Europe will also suffer from lower economic growth. Again, it's going to be partly offset by lower interest rates and partly offset by higher government spending, particularly in Germany. But clearly the Europeans are going to experience lower economic growth than they would have done absent Trump administration tariffs.
Now maybe we can lump almost the UK into an emerging market these days, but just thinking about your secondary effects of some of this, and we have our BRICS, our Brazils and India and China, and Russia, and we have the states that I watch very closely, the Gulf Arab states. What are some of the impacts that we can see of this restructuring of the global economy, away from the U.S. being a market where things go to, and a possible economic slowdown? What are some of your favorite examples of countries that might be a bit more of a winner and of countries that might be a bit more of a loser in this process?
So most directly, the countries that will be big losers, relatively speaking, are the ones that face very high tariffs if reciprocal tariffs are introduced. So you think of countries like Vietnam, and there's a bunch of other, I think Sri Lanka was amongst them as well. So these are countries that for one reason or another run very large bilateral trade surpluses with the US. They'll be hit very hard by those high tariffs. Now other countries, they only face the 10% baseline tariff under this policy. And so in relative terms, their position relative to some of their peers improves. But at the end of the day, they still face a 10% tariff. And it's not quite clear that, for example, Argentina, which only faces a 10% tariff, will be able to take advantage of Vietnam sending fewer electronic devices to the United States because Argentina doesn't have the production capacity. Which leads to the more structural issue, which in theory, and we've seen this, we saw this during the first Trump administration and the tariff tensions there. In principle, this could allow some countries that currently have easier access to the US market, in other words, just a 10% tariff. It could lead to investment going to those countries and to production facilities being set up there and then to sort of service the US market from those economies. I think there's a lot of wishful thinking here because, number one, as I mentioned earlier on, the one thing that businesses really hate is uncertainty. So you're not going to go to, say, Argentina and move your electronics production to Argentina. So even assuming Argentina is sort of stable enough to invest there, because you don't know what's going to happen to tariffs tomorrow. We're not quite sure where the tariff strategy is going to end up. Maybe after Trump leaves office, it might be reversed. And a lot of these investment projects, they take a few years for them to be set up and to work. So I'm not sure there's going to be a lot of desire to necessarily shift production from Vietnam to Argentina, for example. On the other hand, there is probably an incentive so far to move production to Mexico, but only on the assumption that Mexico and Canada largely remain exempt from a lot of those reciprocal tariffs, which they are for now, but they face other types of tariffs. The long story short is, in the short run, it's sort of, in absolute terms, negative for everyone just because of the negative demand shock. Some countries are hit more than others. Longer term, yes, you could expect some countries to benefit from this, but only if investors and business people really expect those tariffs to remain in place for the long haul. And I think right now the problem is that no one knows where these tariffs are going to be, and hence you don't want to move all your production from Vietnam to Argentina, and tomorrow there's a deal between Vietnam and the United States, and all of a sudden you're back to, if not square one, to much lower tariffs. So there is just a lot of friction. Economists call this friction, and I think the Trump administration here is I think too optimistic about how quickly also, for example, foreign companies will just move their production to the United States. Leaving aside the cost issue, you would really need to commit yourself to saying tariffs are going to stay high and they're going to stay where they are and this is where it is. But if at the same time you negotiate with 75 countries and offer different tariff rates, it creates a lot of uncertainty for these investment decisions. So yes, some countries are worse off right now than others. I think structurally speaking, longer term, it's really not a good thing for anybody.
Well, and then thinking maybe longer term there, Marcus, you kind of hinted at that businesses hate uncertainty. They want to know if this is going to stick around. We kind of have a sense that Trump seems to believe this is part of his legacy. But again, he has to leave power. And if you were to think about these really long-term dynamics, the year is 2029, we have a new president, who knows if they're a Republican or a Democrat. What would be the issues that next administration would be facing that might be a legacy of this, global trade restructuring?
I think the most important legacy will be the diminished credibility the U.S. has as a trade partner. Yes, markets might say maybe there's a Democrat in power, and that's even on the assumption that Democrats would be significantly less protectionist. I think they would be, but also we know that tariffs are quite sticky. Once they're there, you have domestic interest groups that benefit from those, so it's not quite as easy to simply remove them. On the other hand, you would think that sky-high tariffs on China or on major allies and trading partners, these would be easier to remove or at least to lower, which already you're getting some sort of traction and some favorable effect from lowering those tariffs. So I think a major effect of this will be the diminished credibility of the U.S. as a trade partner. I can see a scenario where a Democratic president comes in and reverses much, if not all, of those measures and tries to stabilize international trade regime. But I would also hasten to add that this trend towards greater protectionism in the United States has been long in coming. This is not something that started under Trump 2 or under Trump 1. Biden was not particularly pro-free trade. Even Obama and Bush, they weren't particularly pro-free trade, even though under Bush you still had a number of free trade agreements being signed. But there's been a gradual shift going on in the United States for the past 20, 25 years where it has become less pro-free trade and more protectionist. But I think what we've seen over the past few months really is quite extraordinary in terms of the level of protection. So it's a diminished credibility. I think there's also going to be sooner or later a question that this administration will ask itself, but also others, is that the right strategy? Because coming out of World War II, of course, the United States built a partially global system based on free trade, based on access to markets, and based on global security guarantees for its allies. And I think this might also be shifting. And to the extent, of course, that countries now that lose access to the US market or only have diminished access, they will turn elsewhere. They will turn to China. They will turn to the European Union. So these things might really shift quite, I would say dramatically. The US will always be an important player. But also, by the way, just to put this in perspective, the United States accounts for around 15% of global imports. So, 15% is not 50. Coming out of World War II, the United States was really the dominant economy in the world. It is not that dominant anymore. And the Chinese economy is already larger than the US, depending on how you calculate it. So I think for the US, it would be the need to reestablish credibility, and this could be hard to do because let's assume on the assumption that a Democratic president would be less protectionist. Who knows who will then come in 4 years later? And what you want in national trade, the reason why the system was set up the way it was set up is precisely to produce credibility. So I think what we are seeing is countries saying, okay, fine, then we'll try to find other markets. Now, probably few of those markets can really substitute for the lack of access or diminished access to the US market. But, you diversify at the margin. So the Europeans, for example, they're very keen to negotiate and sign FTAs. Just this morning, you saw on the papers, India and the UK are close to an FTA, allegedly. So everyone will try to diversify their trade and lock in trade and free trade with its partners. And so it's going to be difficult for the US to come back. On the other hand, of course, sure, if they come back and say, we're going to offer you significant reductions in tariff rates, then countries will sort of start doing business again. But I think they will be much more mindful about how risky it is in the longer term.
And then I would be remiss, Markus, if I didn't ask you the question that pops up on social media all the time, but is this trade restructuring the beginning of the end of dollar dominance?
That's the $1 trillion, $30 trillion question. I'm going to go with no, in the sense that if this is only about trade and if we've seen the worst of it, so yes, we might get some of the reciprocal tariffs, we'll maybe get some more sectoral tariffs. I don't think this per se is going to sink the dollar or much diminish it as a global currency. For one very simple reason, right now we don't really have any major really good alternatives. And as long as the US remains open from a capital flow perspective, as long as the US does not default on its debt, the dollar will still look quite attractive. So I would separate the trade side slightly from the dollar side. I do know that a few weeks ago, markets sold off in a very unpredictable way because of those tariffs. But you can explain this in different ways. You can say, yes, there's a general loss of confidence in the dollar. There's other ways of saying it was a liquidity issue. It was perhaps official buyers dumping treasuries short term. There's a variety of explanations. We simply do not know yet what happened. It is true, I think to me, it's less the trade policy part of that story. It's more the fact that if trade policy can sort of go off the rails to that extent, markets and also investors who deal in dollars and hold dollars will be asking themselves, well, if trade can go off the rails in this way and really fantastically change for the worse, then what else could the administration do going forward that could diminish the attractiveness of the dollar? And there are indeed some proposals floating around, if not around the Trump administration, around was published by people who are in the Trump administration. And some of those proposals, like, for example, forcing foreign official holders of U.S. government debt to refinance their treasuries long term to finance and help support U.S. security commitments, these will be things that will be much, much harder to swallow. But then again, you have countries like Korea and Japan that really have nowhere to turn. So yes, I think what's happened has at the margin diminished the importance of the US dollar in the sense of investors and economic agents are weary about what could be done to the dollar. I don't think it's the trade per se. It's more like trade, and the fact that trade policy could have turned that extreme could also be a signal that the administration might end up pursuing policies that could hurt the dollar. I don't think that's massively likely because correlation is not causation, but we did see the Trump administration suspend the reciprocal tariffs in response to a massive and very extreme or very unusual market sell-off in U.S. Treasuries. So I think there is a recognition, even among the more protectionist parts of the Trump administration, to say, well, we want to push that, but we can't afford to push it so far as so that it leads to serious financial market dislocation. So on average, I'm still going to be favoring the dollar short and medium term. But again, the risk is this idea that dollar dominance is in part based on reasonable economic policies, on the rule of law, on predictability, and I think some of the credibility bit and perhaps even the rule of law bit or the predictability bit that's tied to the rule of law is perhaps a little more in question. And rule of law is actually the wrong term to use. It's just the fact that the executive or the president can take so many measures that could hurt the dollar, and there's no guardrails around what he can do. And I think investors beginning to realize that these guardrails are not as strong as they were, and that's why I think they've taken a slightly less favorable attitude towards the dollar.
Well, I had to ask. It's going to come up again and again, Markus, as we continue to see this restructuring of not just American economic power, but its military and geopolitical power, which, of course, our website, RANEnetwork.com, covers extensively, and I cover extensively through the Middle East. So if you're interested in delving into more of that, our website is a great resource to find out about how the multipolar environment is unfolding. Markus, thank you so much for joining me for this extended podcast. This is a really important discussion. It is not the last time we're going to talk about trade, I feel. Maybe in July, we might need to have a revisit to see just how far Liberation Day 2 might go.
Thank you so much for having me. And I think it might be good to reconvene in July and see where we're at.
All right. Thank you so much, Markus.
Thank you, Ryan.
Thank you both for coming on the podcast and sharing your insights. As Ryan mentioned, you can read more analyses on this topic on our platform. To sign up, visit RANEnetwork.com, where you can learn more about our suite of risk intelligence products and solutions. That's RANE network.com. Thanks for listening.